Hey everybody, this video is for the our ACC 203 online class. We're in module 2 this week, chapter 19, and I just want to do a quick presentation. I want to do a quick presentation on overhead rates, how to calculate overhead rates, how to allocate overhead, because that's a big component of this chapter, which is probably a little bit unique to what we've learned in the past. So what is overhead, right? So overhead includes anything that is not directly associated with a product. However, the costs are needed. They're needed in order for the production of this product to be completed. So there are costs that are not easily traceable to a product. We talked about previously in this, if you looked at the presentation and did the readings in chapter 19, we talk about direct material cost, which is the materials used in production, which you can allocate directly to a product or a job by using a requisition form. So there's a raw materials inventory. If you go into the raw material facility, you write out a requisition form with a job number. You then take that material and move it to the job work in process. That can be directly, those costs are directly attributed to the job. Direct labor is similar, right? So direct labor is labor that's incurred in order to produce the product and move to work in process inventory. So what happens there is, we have timesheets where we can track all the various labor that's required for production. And when someone writes out their hours, they can put the appropriate job numbers or product numbers, assign it to that job or product, and now we have direct labor costs, right? But overhead is a little bit different. Overhead are things that we can't directly attribute to a product or a job, but they're costs that are needed in order to produce this item. So things like electricity, things like rent, depreciation of a building, these are all associated with overhead. So as we accumulate these costs, we're going to debit this overhead account, right? We're going to debit this overhead account, and we're going to accumulate all these costs. And then what we need to do is figure out a method to allocate these costs, to credit this account and debit work in process inventory for all these different overhead costs. So we need to come up with some sort of framework methodology to do that. In order to do that, we first need to come up with a predetermined overhead rate. And the formula for the predetermined overhead rate is estimated total factory overhead cost. So this is an estimate. We're going to look at all these costs that we can't trace to a product and come up with an estimate for what they are. And we're going to divide it by an activity base. And for this course, the two activity bases that we're going to see most often are direct labor and machine hours, right? So basically, we're going to take the total estimated cost and allocate and divide those in the denominator by some sort of activity base. And that's going to give us a rate. So in this example, we have $50,000 of estimated factory overhead divided by, we're going to use labor hours as an activity base, 10,000 direct labor hours. That's going to give us a rate of $5 per hour. So this company is using labor hours. So every time that we record direct labor, we'll have a direct labor cost. It'll be direct labor hours multiplied by someone's hourly wage. We'll also, for this example, every time we apply direct labor cost, we're going to apply overhead using direct labor hours. So the same hours that we use for the direct labor cost, we're going to use for overhead. So, but in this example, it would be the labor hours for the project multiplied by this predetermined overhead factory overhead rate of $5 per hour. So every time we compute this and allocate it to work in process inventory, we're going to credit factory overhead and debit work in process inventory. And then here was an example here. So we have two jobs. We're using direct labor at a predetermined factory overhead rate of $5 per hour. So we have two jobs, job 71 for 350 hours, job 72 for 500, right? We're going to multiply those by the factory overhead rate. So the total factory overhead to be applied is $4,250. The journal entry to apply that factory overhead is to debit work in process, which is the inventory account, and to credit factory overhead. Now, we're going to skip ahead and we're going to talk about, this slide right here. So because we're using estimates and we're using this factory overhead account, factory overhead, we're going to debit all the actual overhead, the actual expenses to that account, and we're going to credit this estimated factory overhead rate with the actual activity hours. But because the rate that we're using is an estimate, because it's an estimate, it means that we could have a situation, and most likely we will. Most commonly, we will have a situation where factory overhead is either under or over applied. So if there's a debit balance, meaning if we applied more actual cost than allocated cost to work, the credit to work, and the credit, which then gets allocated as a debit to work in process. If we've allocated more actual cost than we've allocated, we're going to have a debit balance. It'll be on the left side of that T account for factory overhead. We'll have a debit balance. And that debit balance means we haven't applied enough overhead to the projects. That means that we're under applied. If we have a credit balance, meaning at the end of the period, the T account for work in process has a credit balance, that means that we haven't accumulated enough actual cost to offset what we've actually applied. That means that we over applied. We applied too much cost to the products. And it's just because our estimate wasn't accurate enough for the predetermined overhead rate, which is okay because estimates are not always accurate. It's the best guess, it's the most scientific guess that we can make, but these estimates are often incorrect. So if that were to happen, if we're under applied, meaning if we have a debit balance in factory overhead, we need to close out that factory overhead account at the end of either the calendar or the fiscal year. So before we can go from one year to the next for the accounting records, we need to close out this factory overhead, right? So if we have a debit balance and we're under applied for factory overhead, we have too much actuals than we actually applied, we need to close the account out by debiting cost of goods sold, which is an expense on the income statement, right? And we need to credit factory overhead. If the opposite situation occurs, then we need to debit factory overhead and credit cost of goods sold. So if we have a credit balance in factory overhead, we need to remove that credit balance at the end of the calendar or fiscal year before we can move on to the next year. We need to then debit the factory overhead account and credit cost of goods sold. So this was a quick summary on factory overhead, how to apply it, and then how to close out the account if it's over or under applied using cost of goods sold. So that's all I have for here. If you have any questions, please email me. Happy to help. We can set up office hours if needed. And until then, I will talk to everyone later. Thanks.